All right, excellent. Thanks everybody for coming. I appreciate your interest in our event despite the somewhat unusual weather conditions. It's a little unpredictable here every now and then. It's appropriate though for today's topic because we're going to hear about the future of flood insurance. I'm very happy to welcome Dr. Carolyn Kousky from the Wharton School Risk Center and Policy Incubator to tell us about this topic today. And so, Carolyn, you're an economist by background, right? So we're going to do this economic style, very interactive. If anybody has some comments about the first slide or anything, feel free to jump in at any point. And our goal is to be done by 1:45 or so please take it away.
That's great, yeah, thanks so much for having me down. It's really great to be here, and thank you for braving the weather. It's really terrible outside, so let's just keep this informal, so please interrupt me. Economic style works well. This is actually going to be a policy talk, though, and what I'm going to do is work through some of the policy issues surrounding the flood insurance program right now. And I'm not sure sort of where everyone's level of familiarity is with the program, so just interrupt me and stop me at any time. Before we do that, I just wanted to say a quick word about what it is that I'm doing up at Penn, because I was actually right over here at Resources for the Future for 9 or 10 years, and I've been up at Penn now for a year and a half, where we've been at a research center associated with the business school that's focused on risk management topics. And we've been launching this latest initiative called the Policy Incubator, which is designed to be like a business incubator, but instead of identifying promising products or entrepreneurs and getting them ready for investors, we're identifying promising public policy ideas and getting them ready for piloting or implementation. So part of the effort is to bring social science to bear much earlier in the policy process than is typically standard. And we're working entirely in the risk and resilience space. So if anyone wants to learn more about this, please follow up with me afterwards. So what I'd like to do today is just make sure we're all on the same page about what the flood insurance program is, and then work through what I see as sort of 5 big policy issues surrounding the program today. So talking about getting more people insured against flood, improving our communication of flood risks, addressing affordability challenges for low-income families, talk a little bit about the emerging private flood insurance market and what that means for the federal program, and then if we get to it, risk reduction. But we'll just work through as much as we can before the time's up, and I'm happy to stop and go deep on whatever people are interested in. Does anyone know about the flood insurance program? Okay, great. For the rest of you, this is the 50th anniversary this year of the flood insurance program, so it's been around for quite some time now. It's designed as a partnership between local governments and the federal government. So local communities can opt into the program. When they do, they have to adopt minimum floodplain management regulations, and then in exchange, all their residents become eligible to purchase flood insurance through this program. You can see that it's largely, I don't know if you can see this, but the green is single family, and then the blue and yellow are other residential. So you can see the program is largely a residential insurance program, but it does insure businesses and municipal buildings as well. Right now there's about 5 million policies in force nationwide. Very early on in the program's history, Congress realized that nobody was buying flood insurance. And so to encourage greater participation in the program, they actually made flood insurance mandatory for properties with a loan from a federally backed or regulated lender and located within a FEMA mapped 100-year floodplain. That's also referred to as a special flood hazard area. And so FEMA goes out and maps this 100-year floodplain for all participating communities. So that's the basic structure of the program. We'll get into some more details. All the pricing is set by the NFIP, which is housed in FEMA, and they bear all of the risk, although private companies write the policies and process claims in exchange for a fee. I don't know if you can see this very well, but the program is heavily concentrated geographically. So 3% of counties in the US make up 75% of all the flood insurance policies. And those are what you see in red here. So that's 3/4 of all the policies are in these counties, and you can see that it's very much concentrated along the hurricane-prone coast and then other areas of high flood risk, like that's Sacramento, for example, over there. And this is just to give you a sense of how the number of policies in force has been changing over time. For several years, the number of policies in force had been declining. Just last year, FEMA finally got that to turn around. We can talk through some of the efforts that led to that. The decline had to do with some price changes that we'll also walk through. Okay, unless there's any kind of background questions, I'm going to jump into these policy issues, and then as needed, we'll get into some specifics of the program, if that makes sense. Okay, so the first is closing the flood insurance gap. The insurance gap is something that's talked about usually, often in regards to developing country markets, and it's kind of usually defined as the difference between total losses and those losses that are insured. So what percentage of losses are actually uninsured? In this context, we're usually actually talking not about total dollars, but about the number of properties that are at risk. What share of at-risk properties have insurance? And the answer is very few. And because of this, FEMA has adopted what they're calling a moonshot goal of trying to double the number of policies in force nationwide by 2022. So trying to get from that 5 million up to 10 million policies in force. So I want to start by talking about why do we care if people have flood insurance? Why is there a public policy interest? Why does the government have an interest in making sure people have insurance? And that has to do with the fact that insurance plays a large role in promoting household and community level resiliency. And that's because insurance provides larger and faster payouts than almost any other form of post-disaster recovery. So there's often a perception that federal disaster aid will make victims whole, and that's, I'm gonna have a slide on that in a second, is actually not true. Federal disaster aid for individuals is extremely limited. And so that means that if you don't have insurance, your options are pretty limited. If you're very affluent, you might have savings in order to rebuild. 6 out of 10 families do not have $500 in case of an emergency. And flood damage often is way more than $500. So for many families, if you don't have insurance, you're in real trouble after a disaster. The federal government does make loans available through the Small Business Administration, and that is the primary forms of recovery for a number of households. But there's a population of households for which they either do not qualify or it's challenging to take on additional debt. And so that's why there's sort of this interest in insurance. And there's been some work showing that as households are insured, one, it limits these financial shocks to the household. That in turn blunts negative multiplier effects that can happen in communities when people can't rebuild and get back online quickly. And there's also been some research showing that those with insurance are much more likely to rebuild than other households. Okay, this is just the numbers to kind of drive home this point about federal aid not really making people whole after disaster. So if you look at these numbers, so FEMA provides these grants called individual assistance grants, which are typically what you think of as sort of the free money after a disaster for households. Their maximum is $33,000. They're never more than that. The average for most disaster events is only a few $1,000s. And that's because these grants are to make people's homes safe and habitable again. They are not designed to bring you back to pre-disaster conditions, and they will not give you money to come back to pre-disaster conditions. They're to make it so that you can be in your house safely, and that's it. So to actually rebuild and put things, bring your house back, you have to have insurance. And so I think these numbers are very telling. After Hurricane Harvey, the average FEMA grant was about $4,000. The average flood insurance payment was $150,000 or $120,000. So you get much more financial resources through insurance. Okay, that's so great. Why do we have this situation? Which is that nobody has flood insurance. So FEMA estimates right now that about 30% of homes in that mapped 100-year floodplain, on average nationwide, have flood insurance. There's a lot of geographic variation in that I'll show you on the next slide. But if you look after specific disaster events, the take-up rates are even lower. And that's because take-up rates outside of the special flood hazard area, we'll look at this too, are very low, and flooding often does occur outside those areas, and if it's a severe flood event, it means it's often exceeded that 1% level, and so of course there's going to be flooding beyond the mapped floodplain. So New York City estimated, for example, that after Hurricane Sandy, 20% of flooded properties had flood insurance. Baton Rouge suffered some really bad rainfall-related flooding, pluvial flooding. In 2016, 12% of homes had flood insurance. Going into Hurricane Harvey, 15% of Harris County had flood insurance. And as Maria approached Puerto Rico, 1% of homes had flood insurance. So we have a huge flood insurance gap in the US. This is what it looks like nationwide, and you again see this concentration on the coast. So what this is showing you is the percentage of residential properties in 100-year floodplains that have insurance. So this is not take up across the whole county, this is take up in those FEMA mapped high-risk areas. And again, you can see for most of the country, it's sort of less than 20%, it's very low. But along, again, the hurricane-prone coast, it gets really high, often in some spots in excess of 80%. So although actually the program was designed and came out of riverine inland flood events, it's really become a coastal flood program in terms of concentration. Yes?
So if you don't have flood insurance, so it's these two programs period, or are there also what would happen if you don't have, or you couldn't get the...
If you're not insured?
Or,
Yeah, so there is an emerging private market. We'll talk about that in a sec.
Okay.
It's only about 5% of all the residential policies in force right now. About 5% are with the private market, so it's not a big thing right now. But some people do have private flood. If you don't have insurance, you can get one of those FEMA grants for a few $1,000s. The first line of defense is to go to the Small Business Administration for a loan, and that will be the primary mode of recovery for most uninsured people. After that, it's friends and family, charity, like other sources. There is a wild card, which is for really big events. Congress will appropriate money to HUD for the Community Development Block Grant Disaster Relief Program, and often in big events, so Harvey, Sandy, Katrina, HUD gets billions of dollars to fund recovery in these areas. And some of that eventually makes its way to households. The problem is it's months or years before that money gets to households. So after, say, Katrina, a lot of families actually ended up getting that HUD block grant money, but it's not available in the immediate recovery period. And so some of them didn't get it until years down the road. So there is like another source of funding, but it just takes a long time, and it's not guaranteed. And communities can decide a lot what to do with that funding, and so lots of them actually don't give it, because it comes so much later, most of them are using it for public infrastructure, for rebuilding public buildings, and for risk reduction. A lot of it actually goes into building safer for the next event.
So how do these take-up rates compare to general, like, home insurance or renters insurance rates? Or
home insurance is, if you have a mortgage, is very widespread. I'd say definitely in excess of 80%, in some places in excess of 90%. So most people with a mortgage have home insurance. Most people also keep their home insurance even after if they paid off their loan. Flood insurance you have to buy separately, and we'll get to it. There's 2 slides, a lot of reasons why people don't do it. Yeah. Okay, this is another interesting map that is spurring some current research we have going on. This is looking at the percentage, so take all the flood insurance policies in a county, what percentage of them are actually outside that high-risk area? And we find that interesting because in that area, there's no mandate to buy for anyone, and there's also no disclosure about risk. So there's a federal requirement that lenders have to tell you if you're in the special flood hazard area because of this requirement. And some states have actually adopted that as a seller disclosure as well. So in some states, that will be part of the disclosures you get when you're looking at properties. And yet you see these pockets around the country where 60, 80% of the policies are actually outside that area. And we think that's really intriguing. So we've actually started a research project digging in on those counties to figure out what's going on there. And our hypothesis is that these are areas of stormwater flooding. So intense rain that overwhelms systems is called pluvial flooding. That's not shown on most FEMA maps. And there are areas where that's becoming an increasing problem, and residents are aware of that and are choosing to insure anyway. That's our hypothesis. Okay, so drivers of the flood insurance gap. There's been a lot of work trying to understand why people don't have insurance, and what we have now is a laundry list of reasons why people don't have it, and we don't yet have a very good understanding about which of these is most important for which populations. So that's still not very clear. But here's a bunch of candidates. On the demand side, people have poor information about flood risk. We're going to talk a lot about this in about 3 or 4 slides, so I'm not going to say any more now, but our communication of flood risk is very poor right now. Second, most people don't understand insurance. Insurance is a weird product for most people, and people who think about insurance a lot, I think, fail to appreciate this. So just a couple examples from our work. I was on a call-in show about flood insurance several years ago when there'd been some localized flooding in the Midwest. And someone called and said, I had this flood damage last week from the floods. Who do I call now to get flood insurance to pay me for those damages I had last week? And so just a failure to appreciate how insurance functions and the sort of pre-funding you have to do. Another thing that comes out of some research papers that colleagues of mine did at the Risk Center shows that often people think of insurance as an investment, and they think of the claims payments as like returns. And so if they're not getting a claim, instead of thinking, oh, I'm so lucky I haven't suffered a flood, they think this insurance isn't doing anything for me, and they cancel their policy. Then, of course, there's all the literature that I'm sure many people are familiar with in behavioral economics and psychology that show that people are poor evaluators of risk. They make often bad decisions under uncertainty, and that applies to the decision about insurance as well. And then price is a big role. We're going to talk about the next slide. Disaster insurance is expensive, and there's almost no way around it being expensive. And that causes a lot of challenges, and we'll talk about some ways around that. And then there's also supply side challenges. So we're going to come back to talking about some of the difficulties in actually supplying disaster insurance from the private sector. But of course, we have this big public sector program, so some of that is a little bit irrelevant for having flood insurance available right now. But there are some limitations to the NFIP policy offering. There's a lot of transaction costs to participating in the program right now. FEMA's aware of this and trying to fix a lot of them, but it still remains the case that it's sometimes very difficult to get flood insurance. Okay, so this is some of the list. Yeah.
Just a quick question on, so if somebody takes a mortgage to pay, it will typically not have a flood insurance requirement. Is that?
If you take out a mortgage,
Yeah.
then your lender will pay a flood determination company a fee to tell them whether or not your property is in the floodplain. If they get back that it is, then they require you to have flood insurance at closing.
Okay.
And that is fairly well enforced at closing.
Okay, so is the reason then that people don't have these things is that they've been living in the same home for a long time and, you know?
Yeah, so part of it is people without loans anymore. Part of it also seems to be that mortgages are, packaged and resold, and that there might not be enforcement over the life of the loan. And right now, what you have to do is actually repay your flood insurance every year, and you have to actively do that. And so lots of people, if no one's checking in, sort of the bill comes, and it might be intentional, I don't want that anymore, and it might just be like, I'm busy, or I throw it away, or I don't pay attention, and I don't renew. And escrowing is now an option for flood insurance, but apparently it's not done very often.
Okay,
and this also presents a problem in terms of the affordability, because unlike your homeowner's insurance, which would come out in monthly chunks, you have to pay the entire premium right up front right now.
That's right.
So unless banks actively work with you to escrow it. So that's also sort of a behavioral barrier.
Yeah, that's right. But I just took a mortgage myself, and I remember that I had to send them documents showing that I live on a hill in Wellington. So
so you don't have to.
It's nice. But the other question I had was, in the news we mostly hear about the opposite problem, which is whenever there's flooding because of sea level rise or something, people say it's terrible that the federal government insures these things despite the climate change risk and encourages people to build in wrong places. So is that an issue, or?
So roughly 20% of properties in the federal program are paying risks that are below a risk-based level.
Okay.
So about a fifth of them are not facing the true cost of their risk. I think there's probably good evidence that those are they're concentrated in two groups: older homes and high-risk coastal areas where new maps have led. So if a new map comes out and shows that the risk has changed and you're actually in a high-risk area, you can keep paying your low-risk rate.
I see.
And for the very riskiest properties, like along the coast subject to storm surge, the CBO had a nice study a couple years ago, or maybe a year ago, that showed that about 3/4 of those are not paying risk-based rates.
Okay.
And then there's a question about sort of what is risk-based rates. And so for the flood insurance program, they say about 80% of them are what we call risk-based. Now, they're not what a private sector firm would charge. And a lot of cases, they're under what a private firm would charge, and particularly in the coastal area. So the NFIP has a separate rate for homes that are literally right on the coast. And then behind them, so areas of storm surge that are modeled at 0 to 3 feet, where there's still much higher risk, they're not paying separate rates than someone who's way inland. So they're not paying for that extra surge risk. That is all actually changing, and FEMA is actually in the process of completely overhauling their rating, because there's actually a number of other problems in the way they're rating right now, and there's actually some things in the rating that are creating these perverse things where low-valued homes are actually paying way more than they should, and high-valued homes, so it's regressive the way they're pricing. And they're fixing all of this, and the pilot is going to be coming out in the Southeast in the spring of 2019, and it should be rolling out nationwide in 2020. So yeah, there's been some problems. Talking too much in answer to your question. But the second part of your question is, people often claim that having insurance drives development. There's no good empirical evidence on that question at all. And part of it is that it's hard to look at empirically. Just the data present enormous challenges to trying to do that. I will say that take-up rates are really low. So if flood insurance was what you needed in order to be building in a high-risk area, we should see higher take-up rates. So that's a little odd. Anecdotally, folks at FEMA have said to me that they think that the program not so much encourages more development, but encourages more expansive, nicer development. so that there are areas sort of along rivers or whatever that used to flood frequently, and so people would build things that would be cheap to rebuild because they knew that they'd be flooded. And now if you have insurance, you actually build something really nice because you can get, and so there's some anecdotal evidence that that has changed building, but again, there's not good empirical evidence on either of these points. Okay. Okay, so I want to just say a word for those of you maybe who don't think about insurance all the time like I do, about why disaster insurance is expensive. Because part of the problem here is someone has to pay disaster costs, right? And the big policy challenge is who, right? And how are we going to distribute these among people? So with non-disaster insurance, you really have sort of a risk pooling mechanism, where the premiums that are taken in a given year are pretty much enough to pay the claims in that year. And that's how some of the earliest insurance worked, right? I mean, so you pool together, and whoever happened to randomly suffer a loss that year would take the money. Okay, it doesn't work that way with disaster insurance because losses are really spiky. So you have lots of quiet years, and then you have this huge loss year. And in order to not go bankrupt, insurance companies have to have access to an enormous amount of capital in those high loss years. And so that's through reinsurance, that's through reserves, that's through other financing mechanisms in the financial markets. So there's a number of ways to get access to that capital, but you have to pay for it. And those prices are then pushed, down. And so in order to solve this kind of intertemporal smoothing problem, it makes disaster insurance expensive. And another challenge here is that consumers really fail to appreciate this because you have these quiet years where risk sort of goes out of mind. And the magnitude of how bad things can be, I think, is also a little bit hard to get your head around. So I should have put this in, but I have these neat graphs that show you that homeowners insurance in Florida is much higher than elsewhere because of the wind risk, right? And in the quiet years, it looks like, wow, like consumers in Florida are really getting screwed because they're paying these really high rates. But it just takes, the 2004-2005 hurricane season wiped all that out for 15 years. Mm-hmm. So 15 years of higher things were just erased in 1 year. And so they don't appreciate how long you have to kind of have this. And if you look at, say, the Northridge earthquake in California, insurance companies paid out more claims from the earthridge than they had ever collected in earthquake premiums, ever, in the state, in the whole history of the state. And so it's very difficult, and so that's why they all actually left the state and quit providing earthquake insurance. Yeah.
I'm from Florida, in South Florida, and I just know some businesses don't get insurance because it's way too expensive, and if they get the insurance, there's little income coming to them to provide for their family. So how would companies, I don't really understand insurance too much, but I just as a kid knew, like my dad's business, he didn't get hurricane insurance, and then the roof went out, but we just got sand from the beach and put stuff up. But I know I don't know. I just know, as you're saying, insurance in Florida is very expensive, and I just knew some businesses don't buy it because of the cost.
They do, and that's true all around the country. There's a lot of small businesses that go without disaster insurance. I mean, there's a number of things. One, sometimes it makes sense to self-insure. I mean, sometimes it's so expensive that it's actually better for you to have a savings account or just know that you're going to figure out other ways to deal with it when it happens. And so that could make financial sense or could not. I mean, you have to look specifically at the case. There are sort of wind coverage is more widespread, even in Florida, because it tends to be bundled into larger coverage. And the commercial market actually for disaster insurance tends to be, for larger enterprises, much more robust. So sort of medium to large businesses will have a comprehensive policy that covers everything. Sort of small, very small businesses function more like the residential market, right? And face these same sort of challenges. Yeah. In the state of Florida, for those who can't find insurance, wind insurance in the voluntary market, there's actually a state program, sort of like the NFIP, but for wind and regular insurance and only at a state level. And in order to try to keep that affordable, the state of Florida actually also has its own reinsurance program to make the reinsurance cheaper. So there's a lot of things to try to keep insurance available and affordable for people. Okay, so what we're actually doing right now is we have some work looking at policy options for closing the flood insurance gap. And we've been looking at policies in these 5 topic areas. And what we're doing we had a workshop with stakeholders to kind of talk through these policy options to help FEMA reach their moonshot goal. And what we're doing right now is pulling together a brief that'll be out next month for those of you who are interested, that's looking at what policy options here are non-marginal. sort of would really go a long way to increasing the number of people with flood insurance. You know, there's a lot of interesting things with nudges and improving communication, and sort of the general consensus is that that's going to increase take-up rates a few %, and it's not really going to really get them right to their moonshot. So we're looking at other things like having a mandatory opt-out, a mandatory offer, these types of policies that might actually lead to much greater take-up rates. Okay, now let's switch gears a little bit and talk about flood risk communication, because it's my opinion that we do a very bad job of this, and yet we're very close to being able to do a very good job. So that's the optimistic spin on this. I'd like to start talking about flood risk communication with a personal experience because I think it's very exemplary of the problems right now. So as I said, I was here in DC for a long time. We moved up to Philadelphia about 1.5 years ago. When we were looking where to live, we found this property we liked, and I think about floods, so I was like, I have to make sure it's not in a floodplain. And I was pretty sure it wasn't in a FEMA mapped floodplain, but I couldn't find anything. There's no like easy online lookup tool. My realtor had no idea. Since I work with the flood insurance data, I knew that through FEMA you can log on to their national flood hazard layer, which is this. So first of all, nobody knows about this. Second of all, look at it. Is that helpful? It's really not that helpful. All it did was confirm that indeed this property was in an X zone. But that also wasn't very useful to me because this property had a sump pump in the basement and some drainage in the backyard that really looked like it might have stormwater flood risks. And most maps don't include that. And I couldn't get any information. Had this property been flooded before? Why did they install it? You know, it's just impossible to come up. Even if you're someone who's asking all the questions and demanding the knowledge. Okay, so I think it's another one of these motivating questions. Why does that matter? Why is it important, right? Any economist will tell you markets only work efficiently under actually some pretty restrictive assumptions, and one of them is that participants in the market have full information about the things they're transacting about. And so if we don't have good information about the properties, then people are going to not make optimal decisions about where to locate and what kind of changes and investments to make in their house. It'll distort the housing market. I will say there's a large body of hedonic research that shows that this sort of are you in or out of the FEMA floodplain is generally capitalized into property values. So prices in the 100-year floodplain tend to be 3 to 10% lower than prices outside. But what I'm going to get to in a second is that that's not actually the flood risk that people need to know about. So this is what's capitalized. We talk about flood risk in this country as if it's binary. You're in the floodplain and you're at risk, or you're out of it and you're safe. And that's actually very problematic because flood risk doesn't just change at this line, right? And yet lots of people think that it does. Or they focus exclusively on issues of compliance with the mandatory purchase requirement as opposed to thinking about risk management. And part of this is because the maps that we use, the flood insurance rate maps, you can tell just by their name, right? The flood insurance rate maps, they were designed not to be ideal risk communication products, but to implement the flood insurance program, which requires knowing where that boundary is because inside it there's different floodplain management regulations, inside it pricing is different, and inside it the mandatory purchase requirement applies. So they were really designed for this regulatory purpose, not as risk communication products, and yet they're all we have, and so it's what households and communities use for risk communication. But we know, of course, 30% of claims are outside it. That has to do both with more extreme events and maps that are out of date and adverse selection outside of this zone. So we need to be talking about how flood risk varies continuously across the landscape. Within the SFHA, there are areas that are much riskier than others, similarly outside it. Second, most of our flood risk is, I don't know what that pink thing is, but anyway, most of our flood risk communication is focused entirely on probability. So the 100-year floodplain is defined as the area where there's a 1% chance annually of flooding. It says nothing about impacts. So if I have a flood, is that $500 of damage? Is that $5,000? Is that $50,000? We don't communicate that well to people at all. And also that needs to be communicated in a way that people understand, right? What are my potential damages that I'm going to be paying? How many times has this property previously flooded? What damages did it sustain? None of this is ever communicated to potential buyers. Also, so we have very good flood modeling capabilities now. As the private market has emerged, so has a bunch of more sophisticated modeling of flood risk, inland and surge risk for the country. And there's a number of businesses now, at least half a dozen, maybe a dozen, that have now, these startups have arisen to fill this information gap, to provide better risk information at a property level to people. So that's all very encouraging. The problem is that there are all these sort of third-party websites, and people who are out looking for a home, like they don't even know that they exist. and how to search them out. And so it's sort of my strong belief that the risk information has to be on the platforms that people are using. It's unrealistic to ask people, home buyers, to go to a different platform. You're just never going to get a lot of movement that way. This needs to be in MLS listings. It needs to be in Zillow, so that as you're going and you see, oh, the school district, and then you also see the risk scores. This is a snapshot of just one of those companies now that will give you these risk scores. Also, some of them are free. A bunch of them are not free. And I also think that this information has to be free for people. And then finally, we need to be talking about how flood risk changes. So this is particularly true in coastal areas, right, where you have a combination of erosion and subsidence, sea level rise, changing storm patterns, so that many places, certainly along the Gulf and eastern US, flood risk is just going up, right? But it's also true in inland areas where we're seeing from climate change much more intense precipitation events that are overwhelming local infrastructure, and so we're also seeing much more sort of rainfall-related flood risk as well. And we have no mechanism to disclose to people how their risk is going to be changing. So this is your risk now, but you're choosing to live. You're not making a year. I mean, most people when they buy a home are expecting to stay there for some amount of time, whether it's 5 years, 10 years, the 30-year mortgage, and we're not communicating how risk is changing over any of that.
Quick question on that. Do you have a sense of...
This is from a nice Union of Concerned Scientists report that just came out, by the way.
If you think of people who don't believe in climate change or political reasons, don't want to believe in climate change, is this kind of information something that you can communicate to that population, or does it get lost in the politics?
That's a good question. What I can say is that I've found that talking about impacts is not political, actually. Talking about regulating carbon is very political. So for example, in August, I was at an event for the state of Pennsylvania. In the middle of the state, there were people at the extremes of the political spectrum in both directions at this event talking about flood risk. And the state's head of the Department of Emergency Management got up and said, I don't care what you think about climate change, and I don't care what you think about the politics of it. The fact of the matter is that flood events are getting worse year after year in our state. And he said, everyone trusts the National Weather Service, and he put up this data from the National Weather Service that just showed this huge increasing trend in flood events in Pennsylvania. And everyone moved forward to talk about it. So they were okay with change and trends.
Okay.
But they weren't okay then saying that means we need to actually do something about climate change. That conversation, I think, is hard. Yeah.
Okay.
But maybe people have other examples of trying to do that communication. I don't know. Okay, so some solutions. So first of all, the mapping is being changed now. So FEMA's working on showing that gradation in flood risk across the floodplain and changing pricing so that there's not this cliff at the 100-year floodplain where you could be paying $1,500 a year and then drop to paying $500 a year just by crossing the street. And so all of that should be going away. So that's going to be very beneficial. I think that's really good. We also have, there are all these companies that have now taken flood data and made scores in easy to communicate ways to people. We just need to get them together, right, with the Zillows of the world. That's going to happen. That's inevitable. I think that's on its way. A thing that's a little bit of a harder lift is updating our disclosure laws, but I also think this is critical. So right now, the only federal disclosure is on the lender, that they have to tell you if you're in it. That usually doesn't occur until close to closing, and so there's been some research showing that that has very little impact because people don't find out until too late in the process. A number of states have taken that, as I said earlier, and they have actually requirements on the seller now, but it's still just this binary thing. So can we think about changing our disclosures to something like, what if the community has a database of previous flood events and you have to disclose, or it's easy to look up how many times this property is flooded? That's the type of information that would resonate with people, and so can we disclose that? There's some places that are starting to experiment with this. So in Portland, Oregon, for example, they had a really bad flood in 1996, and now integrated into all their property, you can see, did this property flood in 1996? So it's not a full database of all flood events, but they're trying to kind of start doing that. So there's some steps in that direction. Another thing is that there are areas that are frequently flooded called repetitive loss areas. And so you could think about disclosing that you're in a repetitive loss area, because those areas are very, just much riskier than others. And I have a story from Harvey that kind of really drives this home and the importance of information. This is sort of secondhand, but a reporter called me after Harvey to help her interpret this story she heard from someone who said to her, I bought this home before Harvey, like a year before Harvey, and I knew it was in the floodplain. I was told it's in the floodplain. But I thought, okay, you know, I hadn't seen big flood events, and now, after Harvey, I've had this claim. I knew that this property was one claim away from being designated by the flood insurance program as a repetitive loss property. So the NFIP keeps a list of properties that frequently flood. They're called repetitive loss properties. And one, damages are higher, it happens more often. Also, your pricing changes, you have much higher rates, and you have different mitigation, both opportunities and requirements. And she said, if I had known that, if someone had said you were one claim away from this, I never would have bought the property. And that's why, you know, that's the sort of, the markets aren't working efficiently. People aren't able to make the optimal decisions when they don't have that kind of information.
Question.
Mm-hmm.
So I guess the reason that these things aren't being disclosed is because the current owners of those properties have a hard time selling. So you have losers, and they, like, in the sense of, in the economic sense, where they're unable to sell their properties if everything is disclosed. So how would you suggest them dealing with that problem?
That is true. I'm not sure that that's the barrier, though. In the sense that I'm not sure that the individual sellers that happen to be in repeatedly flooded ones that are going to take a hit if you all of a sudden change the disclosure on them are organized enough to be lobbying against this, sort of politically. That might be true in high-risk areas. I'd have to think through it. You do see some opposition from, like, sometimes local realtors, that type of thing, but most of them are actually in favor of any type of information disclosure because they're on both sides of the transaction, and they don't want to sell a house to someone that ends up, you know, they don't want to put you in a home and then have you suffer these floods and be sort of really frustrated with your agent for not disclosing anything to you. So that might be part of it. I think another part of this is actually just a lot of communities don't have the resources in terms of time or technical capability to really do something like create a database online that's, you know, so there's some communities that do and some that don't, so there's a mix of things. But yeah, there's going to be, and you know, this is something that's being looked at a lot in the coastal market, there's going to have to be a reckoning in the housing markets, right? Because there's a lot of homes that aren't priced according to the risk, and there's going to be an adjustment process there, I think there's no doubt. So, yeah. Which might lead in nicely to this question. So talking about flood insurance affordability. So flood insurance affordability, okay, well actually let me start here. So this has become a sort of big policy issue since about 2012 when some price changes were first made. And I first want to differentiate two different conversations that are often grouped together and I think somewhat unproductively. The first is this question of lower income families for whom flood insurance is a true cost burden. They don't have enough disposable income to pay for flood insurance or without sacrificing other important things, right? That's an important challenge. There's a second issue, which is people who have plenty of money to pay for flood insurance and they don't want to because they don't think it's worth it. And they're sometimes talked about the same. And it's important to separate them because the policy options, right, are so different. So for the first, there's been a lot coalescing around this idea of having means-tested assistance. All the discounts, that 20% we talked about, have never been means-tested. So we've never been providing discounts on flood insurance to the people who actually need the help with it. And both sides of the aisle agree on this. So this administration's OMB and Democrats in Congress both agree that they should be moving towards means-tested assistance. They still aren't, which is frustrating, but this is not a political issue. The second is kind of why people think it's not worth it. And this gets to questions of, is the product meeting their needs? We can talk more about that. Do they understand it? Do they understand their risk? Those types of things. So why did affordability kind of finally, and it's been an issue for a while, why did it sort of become an important policy topic? And that happened when, so don't look at this yet, let me give you some. So that happened when in 2012 and 2014, Congress decided to get rid of a class of price discounts in the program that had been given to older homes. So those built before FEMA came in and mapped them, so pre-flood insurance rate map, pre-firm properties. They're old homes that were given price discounts to encourage them to participate in the program and to ensure, even though they'd been built before there were floodplain management regulations and before this was available. Because they were built before floodplain management regulations, they are generally riskier properties. They tend to flood more frequently and have more damage when they flood than what's called post-firm properties, which had to be built to the kind of baseline floodplain management regulations. So So those are now being phased out over time. And every year, their rates are going up between 5 and 18%. That started in 2012, and then the kind of phase-in period started in 2014. And so that's actually started to create for this class of policyholders nationwide this increasing premium, which is starting to cause problems for some. A thing to note about these is that FEMA's regular rating, what they call their full risk rating, depends on the difference in elevation between your first floor and the estimated height of waters in a 100-year flood. So elevation really matters, right? Because if you're high up, even if it floods, your house isn't going to get damaged. Pre-firm properties are not rated based on elevation. Okay, so this shows you the pre-firm rate, and this is the elevation. So no matter the elevation, you're paying the same rate if you're getting the pre-firm discount. This dark color is the post-firm rate. So for these negatively, the term's negatively elevated, that they're very low properties. So really low properties, the full risk rate would be really high because they're so low they're flooding all the time. But they're only paying this. So the yellow is their savings. So for the riskiest properties, the pre-firm discount is generating enormous annual savings for them. It really is a true savings. There are some properties that were older, but were still built higher up. They're still elevated. They actually are losing money by staying with the pre-firm rate. They should be switching to post-firm rates because it's actually cheaper for them because they happen to be elevated. Because pre-firm rates actually, over the years, were increased a number of times through the program's history. Okay, so keep that in mind for a second. So one, if people knew what they were doing, we should only see pre-firm properties still getting pre-firm rating if they're really risky, because it's better for them not to be. This is just why we eliminated the pre-firm discounts, because they're disproportionate share claims because they're riskier. There's been a lot of work on this. We don't need to worry about it. Okay, so I wanted to say something on this affordability issue about these pre-firm, because we've been working on this project with the city of Portland in a neighborhood that's kind of unique in the sense that about 1/5 of properties nationwide are pre-firm. In this neighborhood in Portland, 90% of the properties are pre-firm properties, and it's generally a low-income area. About half the people make less than 80% of the area median income. They're twice as likely to have English as a second language or be foreign-born. It's also an area that's experiencing a lot of gentrification pressure because of affordable housing problems in the city of Portland. And so all of these forces kind of came together in sort of around the 2014 timeframe when these pre-firm rates started going up. And it started creating a real pressure on a lot of low-income families, and they were feeling like they were going to be forced out of their homes. And there's not a lot of other affordable options for them in Portland. So this came to the attention of the local government. So we've been partnering with the Portland Housing Bureau and colleagues at Reed College to look at what's going on in this community. So what they did is something really innovative and interesting, and gets back to what we were talking about, the pre-firm properties. So they started a program, the Flood Insurance Savings Program, to help with flood insurance affordability. There's been a lot of talk, there's been talk for years at a national level of addressing affordability. There's no movement in Congress, and everyone sort of agrees that there's very little appetite for setting up actually some sort of voucher or entitlement program for flood insurance. So without something, they said, what can we do locally? And they started this 3-part program. The first was getting elevation certificates for people, because as I showed you on that graph, if you're actually elevated, you can have a cheaper insurance rate. But to show that, you have to have a surveyor come to your house and produce an elevation certificate for you, which in Portland, the going rate was $1,000. And so in order to get your lower rate, you had to pay $1,000 to have the surveyor come. Most people didn't even know about that. And for these people, that was cost prohibitive. They didn't have a spare $1,000 to pay for that. So for the lowest income people, the city said, we're just going to pay for your elevation certificate. For more sort of middle income families, what they did was they had the surveyor come and just go down every block, right? Like this one, then this one, then this one. And that generated so much cost savings for them because they're not like driving here to do one and then coming back to the office and then driving here. And they had a local nonprofit who was in the house doing other things, which I'll tell you in a second, do the sort of interior measurements, and that saved them a lot of money. So they were able to bring the cost down from $1,000 to $300. So the middle income families were paying the $300, the lower income families, the city paid it for them. And then they partnered with this nonprofit who had been doing home audits for health and safety issues, energy conservation and water conservation in this community to add in flood mitigation to their general home audits, along with grant money to pay for some of these improvements to lower flood damages to these people. So I thought that was going to be their program. they did all these elevation certificates and nothing happened. And people started calling the office and saying, what do we do with them? We have these elevation certificates. And then the city was like, well, call your insurance agent. And they call their insurance agent, and the insurance agent's like, I don't know what to do with this. So then they added in a third part to the program, which I think has been the most interesting in terms of thinking about the flood insurance program nationwide, which is they set up one-on-one consultations with an experienced flood insurance agent for all these people. Because what they found was flood agents don't understand the flood insurance program. It's really confusing and complicated. And so they found that a quarter of participants had, before the elevation certificate, were misrated. And it tended to be on the side of being charged too much. So, and it totally varied. So they might incorrectly say whether you had a basement or not, which is really important for your rate. They might tell you that you had to buy the maximum amount in the program, which is $250,000 of building coverage, when your home's worth $100,000, which is just not true. So there's a whole bunch of errors. So they fixed all these errors, and then they applied the elevation certificates. And that's where they were able to get these savings. So 91% of their participants experienced savings. They ranged up to about $6,000 a year. The average was about $720 in savings. And this wasn't from giving them discounts. This was just fixing rating errors and applying elevation certificates for full risk rating. So this was not even a program to explicitly help address affordability, through a voucher or something like this. This was just what they're calling right sizing insurance. Like, let's get this correct for people. Yeah.
So if you give the elevation certificate and it's not in your favor, will the insurance company increase your premium?
And that was a big misconception. And people were very worried about getting elevation certificates because
For
they thought it
that
could hurt
reason.
you.
That
But it can't. So if you get an elevation certificate and it shows that you'd be better off sticking with your pre-firm rate, you are completely 100% entitled to stick with your pre-firm rate. And they keep your elevation certificate because the pre-firm rates are going up. So there's going to be a point at which it's cheaper to switch to post-firm, and you can just wait until you hit that point where the curves cross. So there's no penalty to it. And that's been a problem nationwide because New York City tried to do this too. They said, we'll buy free elevation certificates for everyone, and no one wanted them because they were worried they'd be hurt. Yeah. Okay. So this also pointed to the fact that people are not getting the help they need in navigating the flood insurance market. And so Oregon just 2 months ago became the 5th state in the country to mandate continuing education requirements on flood. The flood insurance program changes all the time. Congress, is tweaking with it, and there'll be people who got their agent license 25 years ago, and what the program was 25 years ago was really different than what it was today, and there's no requirement that they keep learning about it. So now, if you sell flood in the state of Oregon, along with 4 other states, you have to take courses to be up to date on it. So that's kind of exciting. And right now, we're in the middle of a survey of all these residents to look at questions of insurance literacy, their willingness to pay for flood insurance, and their risk perceptions. So the study's been fielded, we have all the results back, we'll be writing them up.
What's the scope of that survey? Is it just in that community that you were discussing?
Yeah, so it's in the Lenson-Palhurst-Gilbert neighborhood, people both in the floodplain and out of the floodplain, and participating in the program and not participating in the program. And we had sort of 3 parts of questions for it. So the first one was looking at whether they understood things that you need to understand about flood insurance to make a good decision. Everything from, what's a deductible to do I have actual cash value coverage or replacement coverage, these types of things, just to get a scope of. We found that there'd been a lot of work on financial literacy, nationwide, and health insurance literacy. And there's been almost no work on whether people understand disaster insurance, so we're trying to start to fill that gap.
Will those results be broken down by different demographics, income levels, education levels, that sort of thing?
Yeah.
Great.
We have their income, their home value. Yeah, we also we have education too. Yeah.
Mm-hmm. Great.
Yeah. We have a write-up available on all of this already. What the agent has found with the, but the results of the survey probably won't be out for a few more months. We're still kind of going through the data. And then we did a willingness to pay elicitation of everyone. And then we have actually better flood modeling from a local hydrologist than the FEMA maps. So we're also going to see whether people are sort of more aware of their flood risk than the sort of in-out too, because of that. Okay. Now we'll talk about the private market. We're good on time, right? Yeah.
Good.
Okay, so this summer we completed a study for the Department of Homeland Security looking at the emerging residential private flood insurance market in the US. The motivation for this study came from a lot of policymaker interest, congressional agency interest in this emerging private market. There was a lot of big claims being made by lots of players, and it was very hard to make sense of them. So this was really a fact-finding study because there's no systematic data collection on private flood. So what we were trying to do is just document the state of the market. How many policies are there? Where are they? What types of policies? Who's writing? And then what are the drivers of that market? Because there's a lot of interest among some players in trying to promote the private market. There's also a lot of concern that it might have some detrimental effects on consumers, and so we were trying to figure out sort of what the drivers of the market were. So what we did was we wanted to interview every single company writing private flood in the US. I think we got 90 to 95% of them, as well as state insurance commissioners because insurance is regulated at a state level, and then some other stakeholders like some big NGOs that play in this space and that type of thing. So it was a whole bunch of interview data is what this study was. So this is a little infographic we put together to kind of make clear how the market works and who the players are. So essentially this side is the flood insurance program, and by our estimates, as of this summer, that was about 96, 97% of all residential policies in force. So there's a lot written about the private flood market. Right now, it's less than 5%. So you just kind of have to keep those numbers in mind as you're going to. Now, it is seeing year-over-year growth. I mean, so it's just going up, but it's still, I mean, even if you double it, it's still a very small market. Okay, so the consumer calls their agent, or they go directly to a write your own company. These are the private companies that write the policies on behalf of the NFIP, which gets loans from the Treasury to pay its claims. It also gets infusions sometimes from the Treasury, like happened in 2017, where we forgave, I forget, 9, 12, some billions of the NFIP debt. The NFIP has also now purchased private reinsurance on the private market and also taken out a cat bond in the financial markets, which isn't on here, but probably should be. And then there are these like supporting functions. Okay, to go to the private market, you can go to your agent. We should have an arrow like this because now there's a few sort of insurtech companies that are letting you avoid having to go to an agent, because this is sort of a big thing in insurance right now because millennials don't want to like sit down with an agent. They want to just do it on their phone. So a lot of companies are trying to make everything up. Okay, so what you have is sort of two parts of the market. You have the admitted market and the surplus lines market. So at a state level, all insurance is regulated, and you have what are called admitted companies, and they face price and form regulation from the state insurance office. That would be like your homeowner's policy, right? And it is backed by a state guarantee fund. So if your company goes bankrupt, the state will still pay your claims. So you're sort of protected when you buy insurance through the admitted market. All your like car insurance would be in the admitted market. There's also what's called the surplus lines market, and that's for rare, unusual, or catastrophic risks. They do not face rate and form regulation, so they're free to charge whatever price they want, but they're not backed by the guarantee fund. So if you buy from one of these, if they go bankrupt, too bad for you, sort of. So that said, most of the surplus lines companies in the flood space right now are extremely well capitalized, and there are requirements on their capital, and they do have to be licensed to operate in at least one state. So it's not like they're unregulated. Okay, so but we see both admitted policies and both surplus lines policies. So this shows you, so our study was really focused just on the residential market. This is both private and residential, both commercial and residential premiums. And so this gray kind of color is the NFIP, and the blue is the private market, and these are the states. So Florida is overwhelmingly the dominant player in the market for both the NFIP and the private market. And you can see that if you bring in commercial, that the private market has a much larger share because the NFIP doesn't insure a lot of commercial, and there's a lot of commercial only flood or commercial policies that include flood. So about 20% of the market is in Florida, another 20% of the market is in Puerto Rico, and we have separate write-ups on both of these because why they're the dominant places for private flood in the US is sort of different in both of them. So, one thing to keep in mind is that anyone can buy from the NFIP. So you're only going to see people buying from the private market if it's cheaper or if it's a better policy on some level, right? So they have to compete with the NFIP. So in Puerto Rico, you see a lot of private flood, I'd say actually the vast majority of flood in Puerto Rico is now private, because the way the NFIP has been rating did not take account of some specific things about the building stock there. And so for example, these concrete structures, the damage is much less after a flood to a concrete home than it is to your typical home like here. And so the NFIP is essentially charging more than the private sector has to charge across the island. And so they're able to systematically charge less than the NFIP. So, but I want to be clear again, 1% of people in Puerto Rico have flood insurance. Of those 1%, most of them are with the private market. But I'm not saying lots of people have flood insurance because they don't. Okay, and then in Florida, it's a kind of different story. In Florida, the insurance is a big issue in Florida. Risky area, a lot of capital exposed, and the Office of Insurance Regulation has been trying to promote more private flood to increase the number of the kind of offerings for people. And so they've essentially said, we're not going to regulate your price for a number of years. So you can charge whatever you want right now as you learn the market. So this has encouraged more people to start experimenting with private flood in Florida. But you'll see this is sort of take-up rates by county just for private flood. They're not having a big market share here, whereas this is the biggest risk, right? So that's interesting. Okay, a few more findings. Most of the policies are in the surplus lines market. That's not surprising. That's what you'd expect for a new emerging and catastrophic risk. There's some thought that as companies become more familiar with it, we'll see a greater shift to the admitted market. The market today is driven almost entirely by global reinsurance. Global reinsurance has an excess of capital right now, and they are looking to U.S. flood to help diversify. So there are policies being written now that are backed 90 to 100% by global reinsurance. So this is like a big reinsurer approaches a primary insurer here in the U.S. and says, start adding in flood, give us 90% of the premium and 90% of the risk, or give us all of it, and we're just going to totally back it. We saw two general policy types in the market. The first we called NFIP Plus, so this is marketed generally in that 100-year floodplain where flood insurance is mandatory, and it's basically the NFIP policy plus a bunch of other stuff. So always higher coverage limits, so the NFIP doesn't let you buy more than $250,000 of building coverage, $100,000 of contents coverage. It has very limited coverage in basements, so a lot of private firms are offering expanded coverage for basements. And it doesn't have a lot of things that standard homeowners policies would have, so loss of use. So if your home is totally knocked over and you have to pay to live in a hotel, your standard homeowners policy often includes that. They'll pay for that. Flood never pays for that, but these private floods, add that in. That type of additional thing, yeah.
Excuse me, so the graphic you had a few slides ago that had the 96 to 4% reflection. Does that take into account the sort of the excess policy on top of the primary NFIP policy? So if someone has an NFIP policy up to the 250K and then they have an excess policy of 100,000 private company, is that reflected in those numbers?
Yeah, my understanding, if I'm remembering what we did, I think that this includes the excess flood.
Okay.
It does not include lender-placed flood.
Okay, thank you.
And we basically don't have good numbers and didn't look at the lender-placed market. So if you're out of compliance with the mandatory purchase requirement, your bank finds out, they can buy a policy and force it on you. There's a huge markup on those.
A very big markup, yeah.
There's a huge markup, yeah. And my understanding, we did not look at it, so I don't know, but my understanding is that there's kind of churn, like you'll be put with one of these and then that kind of forces most consumers to,
Okay.
but I don't know.
All right,
Yeah, so
thanks.
it doesn't include those, yeah. Yeah, so there's, for a long time there's been this excess market where you can kind of buy additional coverage for high value homes. And a lot of the private policies today are still focused on high value homes. That's their target market is, where there's money to pay, right, for the coverage. What I thought was interesting was that we were starting to see the emergence of this sort of low coverage endorsement to homeowners policy. So in low risk areas. So you have a homeowners policy, you pay a little bit more to have a kind of low coverage. So you might have $20,000 of flood coverage or $50,000 of flood coverage. And there's a lot of concern among some that that's going to be problematic because then people are going to be underinsured. But in some areas, it makes all the sense in the world. So for example, this area we're looking at in Portland, Oregon, it's a shallow flood area. it is never, in a 500-year event, the modeled flood is still like 1.5 feet for most of these homes. So they are never gonna see complete loss like you might if surge knocks your property over, right? And so for those types of properties, a low coverage policy might be all they need and is a lot more affordable. Okay, then as you saw in the Florida graph, we heard from every single company, almost, that there are places they are not gonna write flood. Now what's interesting is that where they're not gonna write flood varies company to company. That's sort of the interesting, I mean, one of the strengths of the private market is the diversity that it provides, right, in the different types of policies. But so we had companies say, we're never gonna write in a V zone, that's that high risk area of the NFIP. We're not gonna write within so many feet of tidal water. We're not going anywhere near southern Louisiana or Norfolk or Miami, just parts of the country we're just saying no. Or there's properties, we're not gonna write negatively elevated, we're not gonna write anyone who's had a prior loss. So there are areas that are too risky for the private sector. And so that means there is going to continue to be a very large role for the NFIP because there are places that's gonna be the only way we get flood insurance, yeah.
Does the NFIP worry that then the pool that they have to insure is riskier and all the cream is being plucked by?
Yeah, so this idea of cherry picking has kind of loomed large here. What FEMA says publicly, so like when the administrator, the head of the NFIP makes statements, they say, we don't care who buys flood insurance to get to our moonshot goal, and it has to be both private. And I've also heard the former head of the NFIP has said a number of times, there is no cherries. Like we are a high risk pool now. Like we don't have super good risks now. So there aren't these so the idea that there are these great risks to be taken out is just, and so it would be an interesting modeling exercise that I haven't seen done, but they make the argument that any reduction in exposure might be beneficial to the program, especially if it gets away from this. They have this huge concentration problem where all their risk is on the Gulf Coast and southeast US. And so if they could shed some of that to the private market and grow inland policies, they'd be in a much better financial position. So I think there's some thinking about how you do that, but yeah, but it's definitely an issue. The consumer, so on the one hand, private flood can be very good for consumers because it can be a lot cheaper, because where it's offered is where it can price compete. So in this neighborhood in Portland, I was talking about a bunch of people who found much, much more affordable policies through the private sector. It also can have much broader coverages, and so it can also be nicer for the consumer that way. So there's a lot of consumer benefits. On the other hand, people are concerned that, the private sector is going into this now. If there's a big event and they sustain a lot of losses, they might get spooked and pull out. If you suffer a loss, they're going to cancel your policy, and so that there might be these sort of negative impacts on the consumer down the road of having more private flood. As it is now, you can always just go back to the NFIP though. So, but that dynamic might not be beneficial for the NFIP either. So, yeah. And everyone said demand remains a challenge. All the private sector people said, right now the problem isn't so much us, it's that nobody wants to buy it. And then there's a lot of thought, can we make this easier by sort of putting flood in homeowners policies? Because part of the concern is that people don't understand that your homeowners policy doesn't cover flood. And there's been a lot of messaging about that around hurricane areas, but there's still indications that this is a problem. People think I have insurance and then they don't for flooding. Or earthquakes, by the way. So this would be great. And so everyone's like, well, this would be great. The consumer doesn't have any confusion. You could basically force diversification because everybody would be having it. So you can have sort of greater cross-subsidization from sort of low to high risk to bring the price down. It would reduce, there's been some legal controversies in hurricane areas. And homeowners companies they take on a lot of education of their consumers about risk. And so it'd be a good way to also increase knowledge about flood risk. That said, big homeowners insurance companies, I'm a little cautious in saying this, but I think it's fair to say, have no interest in doing this right now for a number of very legitimate reasons. So first of all, the places where people are interested in taking on flood in their homeowners are really correlated with their wind exposure. So so for them to start offering flood is sort of creating more of this concentration problem, which means those spikes are going to be even spikier, which means they have to have access to even more capital. So it's going to be even more expensive to provide flood in these areas, right? So that's a concern. There's also a lot of concern that there hasn't been a private flood market, and so and they don't have claims history yet. They haven't been doing this for a long time. So there's going to be a learning process, and a lot of these big companies that write your homeowners policy, they want to take you as a consumer and keep you for life. And so they also don't want to be doing anything that's going to undermine their reputation or what you think of them. So they don't want to offer you flood and then 2 years, 3 years down the line be like, oops, sorry, we were just sort of experimenting with that, and it turns out we're not going to give that to you, or we're going to give that to you, but we have to triple the price, and so they don't feel comfortable enough yet to be really committing to it for the long term, and they're not going to roll out a product unless they really feel they can commit to it for a long time. The fact that let me just say one more thing, that there's a lot of reinsurance interest is also, on the one hand, I would have thought that would have created a lot of comfort with doing more, but actually we've heard the opposite, which is that the reinsurance market traditionally has gone through hard and soft periods, and they have the flexibility to quickly pull out capital from an area. So if they decide that they were wrong about the risk, they just leave, and primary insurers can't do that. Regulators keep them. They don't, think how disruptive it would be to the housing market if homeowners insurance, it was disruptive. This is what happened in California after Northridge. California was mandating that you had to provide earthquake insurance if you provided homeowners insurance, and after those losses, they were like, we can't provide earthquake, and since the state won't let us just take away earthquake, we're not going to write homeowners insurance. And basically, there was no more insurance in the state, and so then there was no property transactions because no lender is going to lend you, and so it was this huge housing market crisis that created a state program for earthquake in California. Sorry.
I'm just going to, anecdotally, I'm really an informed shopper because I have a place at OBX, and we have flood insurance, but I think it's a lack of education here. We're in Fairfax, and who knew that if you're not in a flood zone, and if you have water coming up in your basement, that's flood insurance. You would assume it's homeowners insurance until you have a situation that informs you otherwise. So I think, I just heard anecdotally that happened to others, so I added the rider for flood, and we're not in a flood zone, but I think people don't know that. Same thing, so I did add the flood, but the earthquake, so I questioned, do you add the earthquake as well?
I think that's a really good point, and that type of flooding where it's just coming up from a heavy rain event, that's becoming more and more of a challenge, all around the country. And you're right, and people are told we're not in a flood zone.
So
because you're not, and you might not be near a river or near a coast, and
But who would educate? I don't know who takes the role in educating people. I think we heard that on the media or anecdotally from friends.
Yeah, that's a really good question. Maybe communities. You'd think, my thinking had been you need to tie something to the sale of the property somehow, that's a point at which you could be providing information.
I have one more question.
Yeah.
So those areas where the private market is unwilling to go, is it just because there are alternatives, the market isn't working, or should we conclude that those are places where people should continue living?
We heard a number of companies say there are places that there should not be structures. Yeah, and unequivocally. Or that the structures are absolutely not built in a safe way. And we're not going to insure it otherwise. And I think that's actually where I think that that's actually the biggest challenge right now, is that there are areas, and that is a local government responsibility, and there are all sorts of misaligned incentives at the local level in terms of adoption of building codes or regulating zoning, because local governments get all the tax revenue and bear none of the losses. And we were talking about earlier how, I don't have time to go through this, but just in the last minute here, about how households actually don't get a lot from the federal government, and so I think questions of there's been 2 papers that kind of look at questions of moral hazard at a household level, and it's pretty minimal because they're actually not getting that much, right? Now there is some concern that they think they're going to get it, and so, but at the local government level, they get everything when there's a disaster declaration. They get all the debris removed, they get all the infrastructure rebuilt, they get municipal buildings rebuilt. We've actually had someone say to us, why would I insure my hospital when FEMA just builds me a new one? They actually just say it. So So there's a lot of challenges there.
So it's really the local government that is driving this moral hazard kind of adverse selection problem in this construction building.
Yes, it's on them to be regulating, state and local, to be adopting building codes and decide, and zoning, you know, where we're going to build them.
Because they're bailed out.
Yes, and actually the current, or former, I think the current FEMA administrator has said, maybe we need to rethink FEMA providing public assistance to local governments. And they've put forward a number of policy proposals to try to bring that in a little bit, and of course, no state or local government is interested in pursuing that, but they've said, you know, like maybe we need to have sort of like a deductible where like you have to be taking on a greater share of the losses, and then if it's really catastrophic, of course FEMA's going to come in and help you, but you need to be holding a share of the risk so that there's some incentive for you to be investing in risk reduction, yeah. Which is why, you know, it's how standard homeowners policy, you have your deductible so that you're holding a share of the risk to try to, yeah, so. I think we're sort of out of time. I'll just leave you with one thing that's kind of interesting, which is that in terms of thinking about risk reduction, the federal government does fund a lot of grants for risk reduction. 90% of those dollars are tied to post-disaster supplementals that are all passed off budget. And so we're doing very little pre-disaster. That changed 3 weeks ago. So there was this happy piece of legislation that passed, and now FEMA is mandated to take 6% of the some average of prior years disaster spending and invest it in pre-disaster mitigation for communities. So there's going to be a whole bunch of new money rolling out to communities around the country to start investing in mitigation. So that's nice. Thank you, everyone.